so credit for child and dependent care expenses. So once again, we kind of have to go through some definitions in order to determine who is eligible, what kind of care qualifies, what kind of expenses, before we can even get to the calculation for the credit. So, so the taxpayer, all of the expenses, they have to be employment related, first off. You can't just decide you need a day off from your kids, and so you're gonna send them to the babysitter, and then you're gonna go to the spa. Great idea, but that's not deductible, right? It has to be for employment related expenses to care for one or more qualifying individuals. So we have qualifying expenses and qualifying individuals. So all necessary expenses, including those paid for household services and expenses for the care of qualified individuals, in order that the taxpayer can be gainfully employed, would be eligible. Doesn't mean that the taxpayer has to be employed full-time, but that time it has to be used to generate taxable income. Essentially, what the IRS is saying is, okay, we'll give you this benefit, but you gotta give us a little something in return, right? You gotta give us some taxable income over here on the side. So appropriate expenses would include those for a babysitter, housekeeper, cook, or nanny. So housekeeper and cook actually are included as long as they are for a qualifying individual. Expenses paid to a family member, like grandma, are eligible as long as the relative of the child of the taxpayer is not a child of the taxpayer under the age of 19 and cannot be claimed as a dependent by the taxpayer. So you can't pay your 18-year-old daughter to watch your 3-year-old daughter and have these be qualifying expenses, right? You could pay your 19-year-old daughter to do that, but not your 18-year-old daughter. If they are incurred outside the home at a dependent care facility that provides care for a fee for 6 or more individuals, the expenses will qualify if the facility complies with all of the applicable state and local laws regarding licensing. So it has to be a licensed daycare center as well. Out-of-home expenses incurred while caring for an older dependent or spouse who is incapacitated. So we're talking about somebody, if you have a parent that is your dependent and you're paying for care for them because they're incapacitated in some way, that also qualifies. They have to, though, live in the household of the taxpayer for at least 8 hours a day. So somebody that you're caring for, full time, but they could be living somewhere else, like sleeping somewhere else. And these have to be, the person would have to otherwise be institutionalized. Like they cannot take care of themselves, right? It's either you take care of them or they would have to be put into an institution. So those are the qualifying expenses. Who's a qualifying individual? So someone under the age of 13 who's a dependent of the taxpayer. So that's under 13, so that's 12, all right? So only up to the age of 12 if they're children, or a dependent or spouse who is incapable of caring for themselves and who lived with the taxpayer for at least half of the year. So they have to essentially be totally disabled in order to qualify. Under the age of 13, if they meet the special dependency test of divorced parents, they're deemed to be a qualifying individual for the custodial parent, even if that person cannot claim the child as a dependent. So whoever the custodial parent is gets the credit, as long as they pay the expenses as well. Married filing jointly can claim the credit. Married filing separately can claim the credit only if all of these conditions are met. So they have to have lived apart, furnished more than half the cost of maintaining a household for a qualifying individual, and have a spouse who is not a member of the household for the last 6 months of the year. Okay, so qualifying expenses, qualifying individuals. All right. So how do we calculate the credit? this is one of those, it's not a one-for-one deal. Like if you have $1,000 of expenses, you're not gonna get $1,000 credit. You'll get anywhere from 20 to 35% of the amount that you spend. So again, employment-related expenses, the percentage varies and it's dependent upon AGI again. Between 20 and 35% of the expenses. Maximum amount of the expenses is limited to $3,000 for one individual, $6,000 for two or more. So the most you can get is, the highest amount of expenses is $6,000. $3,000 if it's one individual. Okay, and then you're only going to get 20 to 35% of that, depending upon your adjusted gross income. Again, limited to the amount of earned income of the taxpayer or the taxpayer's spouse is smaller. So whoever has the lowest income, that's the benchmark. So if you've got two qualifying individuals and you spent $6,000, but the lowest earning spouse earned $3,000 in the year, now your limit is $3,000. Okay, so only up to the earned income, which would include anything that is essentially subject to self-employment tax, is what earned income is. So earnings from self-employment would also qualify. Doesn't include those passive types of income. It doesn't include unemployment compensation either. And it doesn't include child support. Let's see. Also, so dependent care assistance, so oftentimes employees will receive, I think we talked about, well, in payroll we talk about this, these dependent care expenses where you can reduce your taxable income by diverting some funds into a savings account. The funds are then used to pay dependent care expenses, right? So if an employee does that, then that further reduces the amount of child tax credit or child dependent care credit that they can claim, because that would be double dipping, right? They've already got a tax benefit by diverting those funds. They can't then turn around and get another tax benefit in the form of a credit for those same funds. Okay. Let's see. Amount of the credit is limited to the taxpayer's tax liability. That means it's a non-refundable credit. Okay, so just like the explanation I put up here. If the taxpayer's spouse is unable to care for themselves or is a full-time student, this is where there is an exception to that employment. The spouse is deemed to have earned income for the purposes of the credit calculation. The amount of the earned income is deemed to be $250 a month for one person, $500 a month for two or more people. In the case of a full-time student, the amount is further limited by the number of months that the taxpayer or the spouse attended school. So if you are full-time, it's gotta be full-time. Say you're working, your spouse is a full-time student for 8 months out of the year, and you've got two qualifying individuals. So they don't have any income because they're a full-time student. So ordinarily, by the rules that we just talked about, they wouldn't be qualified for the dependent care credit at all. However, because they're a full-time student for 8 months, they would be entitled to $500 a month because it's two qualifying individuals, two dependents, $500 a month times the 8 months that they were in school. So they're deemed to have earned $4,000 for the year. So now their limit is $4,000 for the calculation of that credit. Does that make sense? Okay. So here's an example too. Bill and Susie paid $6,400 in qualified employment-related expenses for their 3 children. Okay, so they've got 3 children. Their upper limit would be $6,000 of expenses for calculating the credit. Not for the credit itself, but for purposes of calculating it. All right, so that's their first limit. Susie received $2,500 of dependent care assistance that her employer properly excluded from her income. All right, we can't include that as well. We're gonna have to subtract that out, and we're gonna subtract the $2,500 from the $6,000 upper limit. So their upper limit is $6,000, it's 3 individuals. She got $2,500 of dependent care assistance, so we gotta subtract $2,500 from that. 6,000. Now their upper limit is, what is that, 3,500? 2,500 plus 3,500, yes, okay. So now their upper limit is $3,500. That's the most that this credit could be based on. The amount of employment-related expenses, bill, and oh, that's the next sentence there. The maximum amount allowed of 6,000 was reduced by the 2,500 of excluded dependent care assistance. Okay, they have to apply the dependent care assistance against the 6,000, not against the total amount that they paid. Okay, so 6,000 is always going to be that upper limit. Next, subtract any dependent care assistance received from that 6,000. So Sophia and Elijah paid $3,800 in qualified employment-related expenses for their dependent daughter. Their AGI was $42,000, $40,500 from Sophia, $1,500 of net self-employment from Elijah. Now their limit is $1,500 because the smaller of the two incomes. So their credit can be based only on $1,500. Ethan and Riley paid $4,200 in qualified employment-related expenses. Ethan's AGI was $42,000. Riley was a full-time student for 9 months of the year. She didn't work. She was a full-time student. And it is one son. Now it's $250 per month that she was in school. So $250 times 9 months. Now their upper limit is $2,250. Now if they paid $4,200. If they paid $1,500, they're going to be the credit's going to be calculated based on the $1,500. For all of this, it's kind of the smaller of. You kind of go through this, the smaller of these two numbers, starting with the highest number. Excuse me. So, like the highest would be $6,000 that the credit could be based on. Well, if you had one child, now your credit's going to be pushed down to $3,000. If you had dependent care expenses, now you're going to have to subtract that from the $3,000. If you didn't have income, excuse me. If you didn't have qualified income, maybe you only had a qualified income of $1,000. Now it's going to be down to $1,000 that the credit is based on. Excuse me. So, those are the limitations of the credit. Once we got what the amount of credit is based on, with all those reductions, how much of a credit do we get? It's going to be anywhere between $20,000 and $35,000. Depending on the taxpayer's adjusted gross income. 35% if your AGI is $15,000 or less, and it's reduced by 1% for each additional $2,000 of AGI or fraction. Minimum percentage of 20%. There's a table here to help you. So, and doesn't matter what your filing status is. This is just, so it doesn't matter if you're married, filing jointly, or single, or whatever. So highest is if you got $15,000 or less. Then you get a 35% of whatever the applicable credit is. So let's do like a little example here. Let's just say we've got two incomes of $10,000 and $25,000. I'm sorry, $2,500. And two kids with $3,000 of expenses, qualified expenses. All right. So first off, our maximum amount with two kids would be $6,000. However, they only had $3,000 of expenses, right? So now we're going to be limited to $3,000 of expenses. But also, our lowest income is $2,500. So this is gonna be what our credit is based, what our qualified expenses are based on, is $2,500. All right, so then we're gonna take, so we've got 12,500. We'll say that this is the AGI. We apply the amount of expenses, of qualified expenses, 2,500, times the applicable percentage. So 2,500 times 35%. $875 credit that they receive. Now at that income level, they probably don't have any income tax, but like I said, a portion of the child tax credit is actually refundable. Up to like no, not the child tax credit, I'm sorry, not the dependent care credit. I was confusing it with the child tax credit. None of this is refundable. So if they don't have the tax liability, it's not gonna do anything for them, right? And at that income level, they probably don't have any tax liability, right? Let's see. So Chang has AGI of $18,744 from employment, spent $1,240 on qualified expenses for one child. He would be entitled to a tax credit of $409. So $18,744 is in this range here. 33% is his percentage. 33% of $1,240. If his AGI were $15,200, his credit would be higher at 34%. If his AGI were higher, his credit would be lower at $360. What else? Rachel, single mother, maintains a household for her 4-year-old son, one son, AGI of $34,500, incurred $3,800 in childcare expenses. All right. One child, we're limited to $3,000. So that's our first limitation there. So that $3,000, and we use the applicable percentage from that table above, so she's entitled to a $750 child tax credit. I'm sorry, I said it again. Child and dependent care credit. Now you're all gonna be doing it too, because I keep doing it. Okay, this is the form that's filled out with the child dependent care expenses. So it's form 2441. First part of the form is information about the care provider. You have to have the social security number or EIN. If you don't have it, you can't take the credit. So even if it's grandma, you've got to get her social security number. Grandma should be claiming the income on her tax return. That's why they want to, because it's a deduction here, a credit here, grandma's going to have taxable income. So identifying number, social security number, was a care provider your household employee? So if they were your household employee, there may be additional requirements that you have to provide, they may be your employee, so you have to provide a W-2 to them and all of that stuff. And then the amount paid. There could be multiple, even just for one child. Like if you had different, in the summer they went to the Y or the Boys and Girls Club, but then after school they went to the childcare at the school. You may have multiple providers, but how much did you pay that provider here? That total should be then the same as how much you're paid in total down here. So the first one is about the provider, then this is about the child or the dependent. Who is it that you have paid this care for? So all those, and then the qualifying expenses for each of those individuals there. And then the total amount here. So add the amounts in column D. Don't enter more than 3,000 if you had more than one qualifying person, or 6,000 for 2 or more. So line 3 can never be more than $6,000. Even if it's $20,000, can't be more than 6,000. And then your earned income, all right? Your earned income here, and then if married filing jointly, your spouse's earned income. enter the smaller of 3, 4, or 5. 3 is the $3,000 or $6,000. 4 is earned income. 5 is spouse's earned income, right? If your spouse was a student or was disabled, see the instructions, because that's where you'll go and do the worksheet to determine how much they're entitled to per month based on their full-time status. As long as they're full-time. And then enter the AGI. Line 11 is AGI. Compare line 7, apply it to the chart to determine the percentage. Enter the percentage here. Multiply line 6 by the decimal amount on line 8. So this is this part here. And then there's a credit limit worksheet as well. And then your ultimate line is line 11, the credit. Okay? So, qualifying expenses, qualifying individuals, and then the limitations on the credit before we even determine what the percentage, and then we have to use the applicable percentage based on adjusted gross income. Questions?